May I have your attention? Please welcome Paul Soares, Senior Reporter, UK and European Startups for TechCrunch, Mandela SH Dixon, CEO, Rais, Kevin Liu, Head of Portfolio, Capital and Investments, Techstars, and James Norman, General Partner, Black Operator Ventures.
Yeah, Light's killing me.
Oh my God.
What's up, man?
Hello. Well, thank you for joining us here today. There should be a QR code going up in the screen in a minute for you to submit questions through. So it'd be awesome if you could submit your questions through that. So I'm going to kick things off first with one or two pre-prepared questions on how founders can best understand and negotiate the first term sheet. Now, due diligence is usually something associated with investors, something investors have to do. But I guess it applies for startup founders as well. So they want to know who's planning to invest in them and scrutinize the terms of their term sheet. So I guess it'd be good to know if you could give me one absolute do and one absolute don't that founders should be mindful of when, I guess, negotiating or signing their first term sheets.
I'll give a do.
Okay.
I mean, if you're talking about doing diligence on an investor, I'm always going to talk to other founders that they've invested in, how they treat them, what happens when you're running low on money, like how they actually interact with you. Like that's one do. And I guess for me, a don't would be, don't lie. Like that's the thing. You don't want to try and posture with something that you don't have. You can always, you can embellish a little bit, but don't lie, right? Don't be like, oh, I got so many term sheets, man, I can't talk to you. Like, that'll only get you caught up. That might work 1% of the time with someone who's just like desperate to get a deal done. But like, a don't is don't try and create forcing factors that don't exist.
Okay. Kevin?
I think a do is be very, very prepared before you even enter these conversations, right? Even basic thing, go on the investors' LinkedIn, right? See what they talk about on LinkedIn as an early filter before you even get deeper into thinking about if they would be the right investor, right? There's so many little things I think most founders just forget to do or are too overwhelmed to actually do to get good intel on investors before you have that conversation. On the don't side, I think don't get too caught up in some of the details of the actual term sheets, right? I know a lot of founders get they want to optimize for price, they want to optimize for dilution early on, and sometimes what I tell them is, look, this looks like the best deal you have right now, do a great job in the next 18 months, come back at the Series A and optimize on that round. Right?
Oh, okay.
It's hard to go last. I agree with everything you said. What you definitely should do, irrespective of what investor you're pitching, is be yourself. I know that can feel really hard because in my last conversation on the other stage, I was saying be prepared, understand the rules of the game, but you have to understand this is a long-term relationship. And if you are having an intention to marry someone, you might want to Google the 100 questions you should ask and discuss before you get married. But part of this, you should have that type of intention with investor relationships and bringing your full self to the conversation, because whatever you sell them on as the character of who you are as a leader, you have to keep that act up for the next 5 to 10 years. And so it's really exhausting when you are presenting yourself as something than you really are. And so I really just welcome you to find that balance between understanding the game that you're playing, the culture that you're entering, but also being true to yourself, because I've seen so many founders who are well-funded, but they're miserable. They're miserable because they made an agreement to be something they're not, and they kept having to keep this act up. So just like really have that conversation with yourself about like how you want to show up in an authentic way, because it also gives the investor permission to be more authentic too. And again, there's a power dynamic, there's money involved, there's legal involved. The thing I also want to mention is ask them how the communication, what the expectations are around communication once the deal is done. Right, we've been talking about like how do you get the term sheet, what should be on the term sheet, but there's this most of your relationship will be after that. So having a shared agreement on are we expected to send monthly investor updates? Am I the founder going to be working with you, the GP? Are you going to hand me off to the analyst and associate? And that's the person, right? Where dissonance happens and disagreement in relationships is when there's not a shared agreement. right? And so get clear on your communication post the term sheet and the investment as well.
I want to double down on a couple things they said. Definitely don't over optimize yourself on dilution, right? Like what they're saying, like you're going to give up a piece of the company. If you find someone that you really like to partner with, who's really going to help accelerate you, who has some sort of expertise, like just layering on all the things they can bring to the table, take that into account, right? And think about, what does it look like? Always think to yourself, like, what does it look like for me to have 100% of zero? Then be like, what does it look like for me to have 90% of $20 million? Okay, and keep that going to the point where you're like, what does it look like for me to have 5% of $20 billion? Like, keep that in mind. Like, don't over optimize for that, because you're just spinning your wheels at that point. The other thing is, this is specifically for Black founders. Like, think about how you show up. Like, you can try to show up in ways that we may have been kind of taught to show up in a professional environment, to get a job, to get a loan, things of that nature. You're not actually building a relationship with the person that you're getting a job from or getting a loan from. It's chase. You might be trying to show up and do that, and it might convert for you because they get comfortable that you're safe. In this situation, whether you show up trying to act like you're the archetype or not, you're still not getting the check. So you might as well be yourself, and in doing that, you're going to lessen the mental cycles you have to do to present yourself in that room. What you're going to do is you're going to open up this opportunity to take advantage of something that's actually inherent to you as a Black person, which is actually being one with community, being one of authenticity, being one of your word, being someone who builds relationships naturally. That's the superpower that you have as a Black person. And so if you try and step away from that to be like someone else, you actually can't leverage your only superpower to actually get this done. Because it's a relationship-driven game. And when you naturally come as yourself, the no's, the things of that nature, they start not to mean as much. So you can go meditate, you can go separate yourself, you can take a little break, but you can come back to being yourself. And like, that's the only way you're gonna really see yourself through this.
And if you don't believe you can be yourself, I want you all to go look up Toyin. She is a Black female CEO of a company called City Block Health that raised nearly $1 billion, and nobody knows about her, right? There's also Phaedra Ellis Lampkin from Promise, who's raised over $100 million. There is Heather Fernandez of Solve, who just raised over $100 million. So there's examples of people who are walking in their truth and may not have the same visible diversity, or sorry, the identity of the people writing the checks, and they are still winning. So it's very important for you to see examples when you feel like, if I'm myself, I'm not going to get the bag.
Okay, the questions are now coming in thick and fast, so I'll try and get through as many of them as I can here. So, term sheets, I guess, are daunting for first-time founders. Who should they be speaking to before signing them? So, should they be speaking to lawyers? Should they be speaking to other founders? What's the sort of things they should do?
Yeah, so before today, I messaged about 20 of my founders. I was like, what's the best advice you have? And overwhelmingly, they said, ask your lawyer. Get a good lawyer that has experience with equity rounds, right? Don't just talk to a random lawyer, because that lawyer who knows how to do this, they'll know what's market rate, right? They'll know what the terms are, they'll know what other investors are thinking, and hopefully they represent your interests, right? I think the legal guidance is a big one.
Yeah, it's a big one, because I don't know, I have beef with this because I feel like I could do this shit myself, but you can't actually go negotiate a term sheet with their lawyer. Their lawyer is not going to take you seriously. So like, having the best legal just puts you in a different world. My lawyer actually got mad at me the other day because I do know how to do this. And I ran the whole process with the same emails. He called me, he's like, who do you think you are? Like, you didn't do the filing with the SEC. Like, just do your job, I do my job. It costs a couple $1,000s, I do my job. Don't do that again. Like, because he's trying to look after me, not just trying to get the process done, but like the order of the process of order, like how everything is done, making sure everything's buttoned up. So when you do go to that next round, or you do have an exit, like there's nothing to look at in your paperwork, everything's organized and ready. That only happens when you go with a real legal firm that has experience in startups. And like for me, that goes like Gunderson, Wilson Sonsini, like Cooley, DLA, like these are the people you should be touching base with, because they're the ones working with all the other companies you see exiting.
Okay. Do you have anything more to add to that, Mandela, or is that covered all
I
bases?
co-sign the gentleman to my left. I really, because I was thinking, I gave advice in the last stage about the importance of consulting with other founders, but really it's very important to have great legal counsel. But you think about this, like you can source information from 50 different founders and doing all that legwork, or you can talk to one lawyer who's been in this game for 10 years and who knows the trends that are happening today and can give you that information. So when I think about building a team as a leader, it's not just people who are on your payroll, right, and your employees. Your team is your legal counsel, your investors, and really thinking about, even to your point, James, about the brand cachet and the weight that those logos carry, right, of different legal firms. Those send signals to the other side as well of like, okay, they really know what they're doing.
Yeah, James Norman legal firm don't got no weight. Wilson Sonsini, they're like, oh, you know what? We better relax. Like, we should just do what Wilson Sonsini said they're going to do, you know?
Do you see many founders signing their term sheets without having consulted anyone? Is that quite common?
I hope not.
No.
So, next question. If you have 20 or more seed or angel investors, is this going to be an issue in getting term sheet for Series A?
I think if you had the right legal, I don't think so. If you got a bunch of stuff hanging out there where you don't know where the paperwork is, and your cap table is not set up, it could be a little bit of a hassle, but if you're properly set up, you know, we've invested in tons of things. They got like 17 people on their cap table. Now we're going to wrap it up in the preferred equity. Everybody's got their stuff set. It's kind of like, if I really want to do if I'm the lead, as long as their stuff's kind of clean, it's my job to clean it up. Like, that's the game. If I'm doing like a preferred equity, like lead seed round.
Yeah, and I think one thing to factor in, just from because I work with so many founders who go through this process, and what they underestimate is the people management process. The more people you have on your cap table, the more people you have to keep updated. So it's really important, again, communication. You set the expectations up front with everyone participating in the round and everyone participating in this leg of the 12 to 18-month journey until the next financing on what the communications are going to be, because oftentimes founders are just inundated with angels and people who really want to be involved, but they don't really need their help, and they're not sure how to have that conversation. So be clear up front about, like, are you just, like, is this relationship, the priority is, I really need this money and I need your network. I don't need your advice right now, right? Like, give them direction, and people really like that in leaders as well. They want to be told how to best be leveraged.
Okay. So here is one from someone who has received a term sheet offer. So my startup received a term sheet with 1 week deadline. Can we negotiate deadline, and what if we have other potentially better offers in the works?
Ooh, I've never been in that situation. Kudos to you, whoever that is. But yeah, the timelines are real. So I don't know, any thoughts on that?
Generally, I would ask the founders to push back. And I've never had an issue where a founder pushed back on a term sheet deadline and it hasn't been okay, right? It's similar to something that I brought up in the other conversation is, if you're at the term sheet level, you have a lot of leverage. The investor wants to do a deal here, and that's something that you should at least ask.
So what would the typical time scale be for?
You could probably extend it a week, 2 weeks maybe.
Okay.
Yeah.
Okay.
Yeah, I want to repeat that again because I've done forgotten the conversation right now. Like, once that term sheet comes, like, this investor has already spent all this time, this money, this work, is emotionally convicted that they want to work with you. So the leverage continues, you know what I'm saying?
Yeah, and I think what I didn't understand until I worked at a VC firm is the inner mechanics that happen and how whatever partner is deciding to put their personal capital on the line to vouch for you internally, irrespective of what the other partners think. And again, different decision-making processes depending on the firm. But there's many firms where if a partner wants to do it, irrespective of what the other partners want to do, they're going to do it. But what happens again is if they give a timeline of something and you are hardballing them, you're going back and forth, it's affecting how they look to their colleagues and partners as well. So that's again, it's just understanding. What I oftentimes recommend is get inside of their mind, get inside of their lived experience. And the better you can make them look, the more leverage you have.
Okay. How much equity should you give away? Pre-seed, 10%, seed, 5%, Series A, 20%.
That was backwards, right? Did you say pre-seed 10%?
Pre-seed 10%.
Seed 5%.
Oh, seed 5%.
Oh,
Yeah.
Oh, I don't know.
Fancy,
Anybody,
yeah.
anybody doing no seed? I don't know how much money you're raising, but
It's,
doing no seed deal, get 5%.
good for you, yeah.
Yeah.
the rule of thumb that I've always shared is do not give up more than 20% per financing round.
Yep.
Like it hasn't really been scaffolded the way you just laid out, where if it's 5%, 10%, it's really like 20% is kind of like the rule of thumb that I've sourced from a variety of investors and the founders, but maybe you two have seen different things.
No, I think that's fair. I mean, I probably wouldn't give up 20% at pre-seed. It's happens regularly though. 15% for sure. 20%, yeah, why not? It's possible.
Yeah, I mean,
Yeah.
to unpack it a little bit, part of the issue beyond just the founder equity and wanting to optimize for that is downstream investors, right? By Series B, Series C, these investors are coming in with $50, $100 million checks. They need to know that there's enough skin in the game for you to keep going on, right?
Yeah.
I saw a company more recently, the capital was a mess by the time it was Series B. The Series B investor had to come in and clean everything up, right? And then create a new structure so that the founders will continue to feel incentivized, right?
Yeah, and you kind of want to stay away from that because that can start to disincentivize
Right.
someone from investing. Yeah.
Okay. So a lot has been said about the balance of powers swinging to investors recently away from founders. So, but I'm guessing the balance of power isn't the same across all first-time deals. One company might already be profitable, another might have just signed their first customer, another might have founders with a track record. So what kind of things do you think might swing the balance of power back towards kind of founders, particularly in the current economic climate?
I mean, if you're talking about raising money in term sheets, the only thing that has power is you got another term sheet. I mean, here's the thing that I recently really realized was the value of derivative, like the rate of change. Like if this company over here makes $1 million, but it took them 3 months or 3 years to do it, right? Good company, great founder, blah, blah, blah. That's cool. Good opportunity in that company. This company over here makes $5,000 from 10, 20, 30 customers. And that $5,000 happened over 3 months because one person used it this much, and they used it that much, and they used it that much. And there's a trend of that going up, and there's like 10 million of these people. Both of those, in fact, this is a more investable company. The rate of change is dictating the momentum that investors want to see, and the momentum is the leverage. The momentum and the term sheet are the leverage. That's it. Like because the train's left. The train is moving very fast in this person's world. The train over there is making stops. It's picking people up. It's doing its thing. It's moving in a direction. But this train over here is like, I don't know if I can catch it. So that's the major leverage when you got the momentum.
Okay.
Yeah, I agree with that, and I think there is always money. There is money out there, and I don't know if this is going to land well, but there's always money out there. Like I remember one day reading the headline on my Twitter feed, and it's like, everything is changing, no one's deploying capital. And then the very next day, I saw a very public-facing founder who we probably all watched the Hulu series about, raise over $250 million for an idea that he had previously funded of two female co-founders, but I'm not going to have that conversation right now. But the point is money is out there. How do you align yourself to that money is always the question, no matter what the economic situation is overall in the market. And so the things to think about is, again, that I've seen investors evaluate companies on time and time again is, like I said, the founder. What is your experience building companies at scale? Right? That's what they're assessing you on. If you don't have that box checked off, okay, next box. How big is this market? How innovative is this solution? How competitive is this market, right? What is your ability to attract talent? What are your networks like? What is your leadership skills like, right? There's all these sets of criteria which they're evaluating on, and you don't have to check every box, but you need to check a majority of boxes in order for them to feel like, all right, I know this is a risky bet, but I'm willing to take this risk. And So there's always money out there, and I don't want people to be discouraged because I know investors are investing right now. Forget what you see on Twitter, they are investing if they have a hot deal. And so the way to tip the leverage in your favor also is, again, you can go after a lot of small checks or small name or no name investors, or you can say, I'm zeroing on these top 3. Because if I can get one of these top 3, even to maybe not invest in me via their firm, but as an angel investor, right? I can leverage their name to get all of the other people, right? So it's about the strategy in which you're enlisting to create the leverage and have it be in your favor. And I think if you do not come from a background like I did, where I had this network and I had this Ivy League pedigree, I didn't have any of that. But what I did have that, honestly, in hindsight, wasn't on purpose. I got very lucky, but my first investor was a name brand investor in Silicon Valley. And I was able to leverage that name all over, and the checks kept coming, right? So again, have a strategy.
I just want to add one more layer to that. Because you're saying, you know, there's certain check boxes that you want to be able to hit, but remember, like, you're not presenting a checklist to investors, right? That's like trying to convince someone that what you're doing is right. You got to take those check boxes and craft it into this story that's like the first pitch is the trailer of the movie that you want to see. And now you've seen the movie, and now, oh, I feel like I want to be in the movie. Like you're painting a picture, right? And that picture has to involve and be relatable enough to the person across the table, and has to involve them. That person wants to feel like they're going to be a part of the movie. If you paint a story that's all about you and how great you are, well, you keep going being great, right? But like, if there's a story being cultivated about how the world's around it and we're together doing it, then like that further like elicits emotion from the person across from you to want to be doing it with you. Like that's what you're trying to do. Like you're trying to pull people in to be a part of what you're doing. It's the same thing you would do if you're trying to hire the most talented person that you can't afford. You're trying to pull that person in.
You know, I'm quite convinced that for 90% plus of investments, the investors walk in having an impression already of what they want to invest in, right? So if you're going to the meeting and trying to pitch a brand new idea, right, and it's not gonna land well, right? You need to appeal to what the investors are looking for.
Okay, that's great. So we've got about 4 minutes left. I'll try and get through one or two more questions here. Here's one that says, does equity crowdfunding hurt chances of investment?
I don't think so.
You know, it's interesting. Like I'd say 3 or 4 years ago, when it was still not as mature, I think there was more of that optics of people thinking that if you win a WeFunder, you crowdfund there, maybe you're a lesser so of a company. You know, I know the WeFunder guys very well. I know the team at Start Engine quite well too. And what I do recognize is for certain kinds of companies, you can get a ton of value out of those in addition to traditional venture, right? Depending on the category, depending on the kind of company, and position, really, right? It's much more accepted today than it was years ago.
I totally agree. Totally agree. It's shifted for sure. I think it had a certain stigma at first from the snootiest of people at the tippity tops of Silicon Valley, like, oh, you couldn't raise from us. There you go, right? Because this ego, this elitism is very real and rampant, right? But I think that's shifted over time as we've had very successful companies prove that this was a viable way to get capital and build successful companies. So now that there's more proof, there's more belief, and other people have come and the stigma's been removed for sure.
Okay. Can you raise and do accelerator at the same time, or should you wait to finish and then do it?
You said what?
Can you raise and do accelerator at the same time?
Oh, you should.
Or should you wait to finish and then?
No, I mean, man, why not? Like, I mean, I guess, hold on, let me qualify that, right? If you've been building companies for a long time and you went into an accelerator to get the opportunity to raise money, as soon as you get on the ground, you should be organizing yourself to raise money. Like I went into 500 startups because I couldn't raise money. I was like, no one believes I can do this. I got no signal. 500 startups will be set signal. So the day I get there, I'm like, all the sales, all that, I'm not interested in all that. Who knows all the people, right? And I still ride with those people to this day. They made all my introductions to get to any capital I ever had. So like that was my intention. Like, but if you still need to learn, you need to build, you're trying to cultivate your idea, you got to focus on the accelerator. That last like 25-20% of the accelerator, you can get yourself together and begin preparing for that fundraise, do your demo day, kick something off. But like, it depends on where you're at in your journey.
I think the answer is yes, right? If you go to an accelerator, you should definitely leverage the brand recognition of the firm to get in front of investors, even if it's like soft meetings in the early parts of the accelerator program, like 100%. Yeah, do not wait till demo day to start fundraising.
Yes, and like you, James, I participate in Accelerator as well, and I just, for anybody who hasn't tried fundraising before, it's really hard. It's like a whole other business on top of your business, and I don't know how large your teams are and who's taking care of things at home base to make sure the lights are on and the charts are moving up and to the right as you're doing these emails and these pitch meetings. It's just, it's a real challenge, like on the floor, on the ground, like doing both at the same time. But I do think, I don't know if it's a dirty little secret, but I do think a lot of accelerators, there's a demo day at the end, right? But the best founders have investors lined up before, right? So again, success is premeditated, planned, and on purpose. So you have to start filling your pipeline so that when they show up to demo day, they've already invested, and then you can leverage that excitement because it's about momentum.
Yeah, like if I didn't have a lead investor going to demo day, I wouldn't have raised anything. It wouldn't have happened. You know, people from outside of Silicon Valley want access to a Silicon Valley deal. I already had Silicon Valley investor. That was that. Did the demo day and money comes in.
Yeah.
Okay, we're just about out of time now, so I'd like to thank you all for coming here and sharing your insights, and thanks for everyone for coming here today.
Thanks, man. This.